financial markets, and I am your host, Victor Chiberu. And it has been quite an eventful day on the Uganda Securities Exchange as well as the Nairobi Securities Exchange. We've seen a lot happening as per the close of today's market activity. But just going straight into the analysis of today's market activity, we're looking at the Uganda Securities Exchange witnessing really dynamic trading activity as of today. And it was marked by significant changes in turnover, individual equity performance, as well as market indices. But this show actually aims to provide a detailed financial analysis of today's trading activities, of course shedding light on key factors that influenced market movements and performance of the listed equities. But moving straight into the market overview, we're looking at a total of about 6,979,099 shares, and they were traded in a substantial improvement of about 896% coming up as the turnover. But comparing this to the previous trading day, that is quite a significant uptick in the percentage of this turnover. But the corresponding market value was amounted at about 148,168,585, and this surge in activity actually signifies increased investor participation and interest in the market, possibly driven by the combination of economic factors, indicators, corporate announcements, as well as global market trends. But the current market capitalization of the Uganda Securities Exchange stands at 16 trillion Ugandan shillings, and we're seeing it going down by a point, but that is the range in which it moves. It's ranging from about 15.8, 15.9 to about 16.2. And we've been seeing these movements within this quarter. But understanding the market capitalization is indeed crucial for investors, as it reflects the aggregate value of all outstanding shares. And of course, it is serving as a key metric of assessing the size and the relative importance of the market. But moving straight into the equity performance, we're looking at 6 listed equities that actively participated within the trading session, and we're looking at a diverse range of performance. But KCB is emerging as the sole gainer, experiencing a 0.36% share price appreciation. And on the flip side, we're looking at Centum Investments that recorded the largest decline with an end-of-day price depreciation of 2.51%, closing its share price at about 205.26 Ugandan shillings per share. Now we are looking at cross-listed equities coming up as the actively performing equities, and we're looking at KCB, or Kenya Cooperative Bank, showing some remarkable performance with the 0.36% share price appreciation. But Centum Investments, of course, could be going through a bit of a tough time within the week. Hopefully by the end of the week we will be seeing promising results from Centum. But other decliners included the East African breweries that showed a share price depreciation of about 1.7%. Cipla Quality Chemicals with a share price depreciation of 0.94%, and Stanbic Bank with a share price depreciation of 0.34%. Now, these individual equity movements, of course, they're really underscoring the performance of a thorough stock analysis for investors seeking for informed decisions. So, of course, taking a deep insight into understanding what exactly is going on within these stocks would be of much importance. But examining the trading volumes, we are moving straight into the insights, and we're looking at investor interest and liquidity in specific stocks as of today. So Bank of Baroda Uganda led the pack with the highest volume of 5.53 million traded shares, which is not coming as a surprise. Bank of Baroda has had its stock being actively traded as the year has been coming to an end, possibly because of financial news and company reports that, of course, investors are finding positive. But we're looking at Stanbic Bank following Bank of Baroda closely with 1.31 million shares traded. MTN Uganda coming up with 102,500. Airtel Uganda with 31,000 31,100 shares with 31,100 shares as in the highest volume as of yesterday. But it is also good to see that Airtel Uganda is showing some results, and hopefully the stakeholders are calm, and they're really ready to attack the coming year with much zeal on the Uganda Securities Exchange. But analyzing trading volumes, of course, it helps investors to gauge market sentiment and identify stocks that are actively traded, and of course potentially signaling areas of opportunity or concern. But market indices and their performance, of course, also matters in this case. So not looking into them would also be of much disadvantage. But the Uganda Securities Exchange All-Share Index came in as showing a decline of about 2.49 points, and of course, it being the benchmark, this is quite a hard hit, and we're looking at a depreciation of about 0.28%, and points to close at 892. But this week is leaving us with a mark of a one-week loss of 1.85% and a four-week loss of about 1.19%, as well as an overall year-to-date loss of 26.44%. Now, the local company index also decreased by 0.1% to 274.69 points, and translating to a one-week loss of 1.73%, a four-week loss of 2.16%, and a year-to-date gain of 0.74%. Now, of course, negative movements in both indices raise a number of questions, and of course, we're looking at questions ranging from about the broader economic factors influencing market sentiment and, of course, investor confidence in this case. But detailed examination of sectors contributing to these losses and an analysis of external factors affecting the Ugandan economy are really warranted. But let's not forget that the Uganda Securities Exchange has really showcased a dynamic market within the past few days of the week, and these substantial changes in the turnover and individual equity performance, as well as market indices, and we're looking at an increased turnover. Of course, they're all indicating heightened investor interest, and while there was mixed performance in the equities, we're looking at the emphasis on importance of diligent stock analysis. Now, the decline in market indices, of course, warrants further investigation into the underlying economic and geopolitical factors influencing investor sentiment. But of course, we are also looking at news within the week from Uganda, and news, of course, concerning the financial markets. We're looking at the newly appointed CEO, Chief Executive Officer of the Capital Markets Authority. We're looking forward to seeing a lot more advancements and seeing how her leadership is going to affect the Uganda Securities Exchange. And of course, we are also looking forward to having her on the show to also give us insights on what she thinks on prospects, on problems, solutions, and of course, you know, there's a big basket we could just select and discuss anything that is of much importance to you, our investors that are tuning in into this show on a daily. So that was it from that was the update from the Uganda Securities Exchange. But of course, shifting our focus to the largest stock exchange on the eastern part of Africa, or East Africa. We're looking at the Nairobi Stock Exchange, and obviously a lot has happened within the stock exchange itself. It of course witnessed a dynamic trading session as of today, and it is marked by notable changes within their trading volume, the turnover and dynamics. But moving straight into the trading overview, at the close of the trading session, we're looking at a total of 61,990,400 shares, and of course they were exchanged in 856 deals, reflecting a substantial 440 And that was an increase in volume compared to the preceding trading day. But the total market value of these transactions amounted to about 905,767,297 Kenyan shillings, showcasing a remarkable 545% surge in turnover. And of course, looking at the number of deals, we're looking at an experience of about a marginal 2% decline. And this, of course, was leaving us at a market capitalization of 1.47 trillion Kenyan shillings. Now, about 47 Nairobi Securities Exchange listed equities actively participated in the trading session, and among them were 14 stocks that recorded gains, while 25 saw declines. Now, this dichotomy in performance indicates a mixed market sentiment, with investors making varied choices based on individual companies as well as fundamentals and market conditions. But top gainers came in. We had Uchumi Supermarket, which hasn't been within the gainers bracket in a while, but they were the top gainer, experiencing about 5.26% increase in share price. Now, of course, we know this is possibly due to positive company news that led investors and other speculators all over East Africa, or probably around the world, to rush and get themselves stock from Uchumi. Now, they closed at a share price of 0.20 per share, and Absa Bank Kenya came in next, followed by Trans Century, as well as CIC Insurance Group, and they all actually posted positive gains, with a share price appreciation of 2.7%, 1.92%, and 1.7% respectively. Now, these gains suggest investor confidence, obviously, and the prospects of these companies, of course, driven by factors such as financial performance, market positioning, and overall economic conditions. Now, on the flip side, we're looking at Liberty Kenya Holdings that found itself at the bottom of the list of performers, registering an 8.81% decrease in share price, closing at 3.83 Kenyan shillings per share. And TPS Eastern Africa Serena, Nairobi Business Ventures, and East African Cables also recorded notable declines, with share price depreciations of 8.58%, 7.79%, as well as 7.07% respectively. Now, the reasons behind these losses could range from company-specific challenges to broader market factors, as well as or any other situation within the markets that could be influencing investor sentiment. But moving on to the key stock movements within the Nairobi Securities Exchange, Safaricom, and of course being one of the most prominent stocks on the Nairobi Securities Exchange, led the day in terms of trading volume, with 59.7 million shares changing hands. Cooperative Bank of Kenya, Nation Media Group, and Kengen followed suit with 428,300, 258,700, and 210,000 shares traded, of course, respectively. And the high volume of Safaricom shares suggests continued investor sentiment and confidence in the telecommunication giants. But moving on to the market implications, what are we looking at, particularly with what we have seen from the market's performance as of today? Now, the significant increase in the trading volume and the turnover, of course, indicates heightened market activity and investor participation. Now, this surge may actually be attributed by various factors such as economic news, corporate earnings, and corporate earning releases, or changes in market sentiment. The diverse performance of individual stocks underscores the performance and the importance of conducting a thorough research and analysis when making investment decisions. But diving deeper into sectoral analysis for this particular case, we're looking into sectoral performance of the Nairobi Securities Exchange as of today, and revealing trends that can be crucial for investors. Industries such as banking, retail, and insurance showed mixed results, with some companies outperforming while others faced challenges. And this sector analysis provides valuable insights for both short-term traders as well as long-term investors looking for diversifying their portfolios, which is of course very important to diversify your portfolio, and it helps you to reduce the amount of risk you could face as a trader. But market sentiment and investor confidence, of course, when you look at these two, the contrasting performances of gainers and losers suggest a nuanced market sentiment. And while some investors may be optimistic about certain stocks, others may actually be cautious due to uncertainties and any other thing that could be unknown going on within the market. But monitoring investors' confidence is essential to predict future market trends and terrifying and of course identifying potential investment opportunities or risks. But of course, the trading session of Nairobi as of today has really shown us a lot that could happen within a span of 24 hours within the East African financial markets. And it has, of course, displayed a mix of positive and negative movements, highlighting the dynamic nature of financial markets. And the surge in trading volume and turnover indicates increased market activity, with investors actively engaging in buying and selling activities. The performance of individual stocks, both gainers and losers, offers valuable insights into the diverse factors influencing the market. So investors and market participants should closely monitor these trends and conduct thorough research, and of course stay informed about macroeconomic factors that could impact the Nairobi Securities Exchange. And of course, the only way you can do that is staying tuned to Smart 24 TV and of course looking out for the financial markets show to make sure you don't miss a thing on what is going on within the East African financial markets. So the financial landscape is ever evolving, and the proactive approach to understanding market dynamics is crucial for making informed investment decisions. But that was all coming in from the financial analysis, of course, in terms of numbers and what was going on throughout today in the financial markets. But focusing on one of the major stocks listed on both the Uganda Securities Exchange and the Nairobi Securities Exchange, we've seen some really important news going on around the media, and of course you know how much news affects financial markets. So we're looking at what is going on within Equity and the recent developments within Equity Group, which is the largest bank in the East African region. And of course it seems like Equity is on an acquisition spree. But looking at Equity Group under the leadership of its managing director, the Chief Executive Officer, James Mwangi, it is actually actively pursuing a strategy to expand its presence in East African markets through acquisitions and mergers. The recent purchase of 99.125% stake in Rwanda's Kogenbach of $48.1 million is a part of this ambitious plan. And Mwangi aims actually to position Equity as a major player in the African financial landscape, challenging the likes of Access Bank, EcoBank, as well as Standard Bank. And Mwangi is actually also eyeing a target of 100 million customers by 2030. And this move is not just about market share, but it is actually a strategic effort to actually dive deeper into financial inclusion and support social economical recovery in the wake of the COVID-19 pandemic. And Equity's plan is also known as the Africa Recovery and Resilience Plan, and of course it is involving lending of 5 million businesses and 25 million individuals. So these acquisitions are actually expected to reinforce Equity's ability to implement the recovery plan, and the bank aims to leverage its strengthened position in the market to accelerate economic recovery in the regions it operates. Now, the acquisition of Kogenbach actually has propelled Equity to become the second largest lender in Kenya. And Mwangi also actually emphasized that the importance of deepening their presence in each country where they operate is really crucial to him. And of course, acquiring banks in different East African markets like the recent one in Rwanda allows Equity to become a stronger player locally. But analysts in Gagents Capital have weighed in on equities performance, and we are looking at they're actually foreseeing a positive outlook for equities full year performance in 2023. They believe that the increased penetration in regional markets will actually drive customer deposits and loan book value, aligning equities high volume as well as low margin approach. But equity subsidiaries in Rwanda and Democratic Republic of Congo seem to be outperforming, and equities top performing subsidiaries in Rwanda and the DRC are actually showing remarkable returns on equity, and the Rwandan subsidiary registered about 41.2%, as well as DRC registering about 28.1%. And of course, this is indicating success in equities strategy on these markets. But looking at the cost to income ratio, a measure of a bank's efficiency in generating profit is favorable for equity subsidiaries in DRC, Uganda, Rwanda, Tanzania, and of course compared to Kenya. But subsidiaries actually become more efficient, and the analysts expect them to contribute significantly to the group's overall performance. And equity actually seems to have pivoted strategically and suspending its Pan-African expansion, and of course focusing on consolidating its businesses in existing markets. And of course the decision is it is bound to lead to their improved performance. Of course, this was happening since 2020, and it was driven by macroeconomic instability in those regions, especially in the wake of the COVID-19 pandemic. So the failed bid we're looking at to acquire banks owned by Atlas Mara Limited in Mozambique, Zambia, Rwanda, and Tanzania, due to the valuation concerns, played a big role in shaping the strategic shift we're looking at as of today. So it remains really interesting to see how equity is prioritizing strengthening its systematic status in each country it operates, and of course emphasizing reaching scale and becoming a significant player in each market. So the goal is not just to be about being present, but being among the top banks in terms of market share as well as impact. And of course their digitization efforts seem to be paying off. And we're looking at 1 million we're looking at a 1 million customer, 100 million customer target. And Equity's massive investment in IT and digitization is actually accelerating its progress toward the ambitious goal. So Mwangi expressed optimism about achieving the target even before 2030. So that remains a really impressive journey from building a society in 2004 to a strong systematic retail bank across the region. So Equity's story is one of resilience, adaptability, and strategic decision-making. As they continue to navigate the dynamic landscape of African banking, of course, it will be fascinating to see how their acquisitions and focus on local markets continue to benefit them and bring about long-term success. No, so that has actually been all from Equity, and that is what is actually going on. So of course this type of news is bound to affect their share price, and we're looking at a bright future ahead as investors for Equity Group. Now of course, any other investor would want to dive deeper into company financial reports and understand how their earnings have been doing and how they plan to implement this strategy without affecting shareholders and actually keeping a smile on their faces. That has been our update for the East African financial markets, and of course we are yet to see a lot happening throughout the course of the week. And of course, financial markets are about dynamic movements, they're about probability, and of course making really informed investment decisions. So that has been all, and I've been Victor Chiberu. Of course, Anthony will be coming in shortly with a guest. Kanso Chizito is going to be coming on with Anthony to discuss financial matters. Thank you for joining us today.
Smart 24, driving business.
Ugandans come to Ginger City every weekend, and December 16th, 2023 is Uganda's end-of-year party as Smart FM hosts the Smart Swag Fest Season 2. Don't miss performances from Uganda's top DJs, MCs and artists like the king herself, City Baby, and her full band, Fig for Maker, UG Boys, Kesmon Switch, King Zamba, Waymaker Official, Voice Nasi, Zaptom Rizla, Lance Soldier, and many more local artists. Let's meet at the Chairman's Back, next to Ginger Showgrounds. Get your early bird tickets now at 15K and at the gate 20K. Gets open from 10 a.m. till late. The Smart Swag Fest is organized by 89 Smart FM and Hot Shots. Powered by Smart 24 TV, Sisan Suits, NBS Cordeo, GZ Mechatronics, Ginger Hippos, Kampala University, Albeit Electronics and Solar Center, TMU Tubing and Rafting, Banshee Uganda, Quad Biking Ginger, Cable Giants, Stardom Visuals and Audio, Bidco, and Club.
Tastefully different. Not for sale to persons under 18.
Cooking oil like no other makes your meal so sweet and scrumptious. The taste of Uganda. Yeah, the taste of Uganda. Jovia.
Ng'oyolekera ku lugendo luno olw'obulamu nkuwa ekirabo eky'amaanyi agatazizibwa, amaanyi okulabibwa n'okuwulirwa mu mawanga ag'ewala ennyo, okutuuka buli wamu nga yadde togenzeeyo, ensi yonna ng'ekuli mu ngalo. Okutambula mu biseera n'okumanya buli kimu ekirina okumanyibwa. Jovia, kino kye kirabo kyange gy'oli.
Tewali kumuku ki ky'osobola okukola ku mukutu nnandameggwa ogwa MTN.
This holiday season, we wish you the freedom to enjoy all your football. We wish you fun and lots of Ugandan entertainment. We wish you a good time together, so turn up the volume on your favorite show and be merry all day long. We wish you laughter everywhere in the home. We wish you and your loved ones a very DSTV holiday. Stay connected to DSTV family at only 64,000 shillings and light up your festive season. DSTV Uganda. It's your moment.
Smart 24, driving business.
Hello, ladies and gentlemen. Thank you so much for watching Smart 24 TV and for watching Financial Markets. My name is Anthony, your host, and I'm glad that you're still with us here at Smart 24 TV. Remember to be part of the conversation. Follow us on Twitter at Smart 24 TV now, and give us feedback also through the comment section in case you're watching on YouTube. Now, the Capital Markets Authority is the body that is mandated to regulate and ensure growth of the capital markets in Uganda. A series of changes have taken place in the body just of recent, with the very latest being the change in the CEO. Mr. Keith Kalijira, who has served the institution for the past 10 years, stepped down to Madame Josephine Osia. And she's going to be coming into this position with effect from the 1st of December, which is already the past date now. And we are, of course, waiting eagerly to see what she's going to bring on the table. Now, under the leadership of Mr. Keith Kalijira, during the handover ceremony that happened at Mestil, he was praised for quite a number of things that he has attained, including new listings and, of course, dedication to strategically attracting new listings, including MTN, Uganda, CIPLA, Airtel, and, of course, injecting substantial capital and enhancing of the resilience in the market. He has also, during the term, been able to actually entice 27,600 new investors, diversifying the investor base. During Mr. Keith Kalijira's term, there was a spearheading of the 110 billion shillings in public and private debt, broadening the investor landscape and, of course, fostering economic growth through a more diversified financial system. This and more is what Keith has been able to do, but still quite a number of challenges remain within the capital market space, with a very limited access to the markets, very little knowledge to the markets, about the markets as well, and quite a number of other challenges that could be cited. Joining me to discuss these challenges that lie ahead of the new team and more is none other than Councillor Louis Chizito. Councillor, you're most welcome.
You're welcome. Thank you for the invitation.
Yeah. How have you been?
Busy. I should say he has been fully fledged with very many things going on. Yes, that's what I should say.
I see. Let's first of all look at CMA right now. We've talked about CMA for quite some time here, and one of the things that keeps popping up is the fact that some of the things that we talk about, especially the visibility of the capital markets in Uganda, information dissemination amongst Ugandans. These are some of the things that we keep mentioning. But for you, according to the new leadership, we're having a new CEO, new communications person, some new board members from last year. What is your opinion on what lies ahead for them?
You see, the Capital Markets Authority have a daunting task ahead of them. I personally don't think mere change of faces is going to go a long way in making the capital markets, well, vibrant. And by capital markets, I'm not just talking about the securities exchanges, all the investment schemes. The capital markets go beyond that. So what lies ahead of them is a task that is very daunting. Capital Markets Authority, from the parliamentary allocations, they are given a budget of 6 billion. As compared to their peers in the region, well, that could be low. But what the team should, I think, lobby for more aggressively, and they should justify why they need more money. So, and if they don't justify their need for more money, because even the 6 billion they got, I think Parliament appropriated 6 billion to CMA. It was, I think, the biggest amount of money they had ever got. I think that was last year, 2021, around towards the end, that financial year. So the team at Capital Markets Authority with the new Chief Executive Officer should aggressively look at how to really get resources, whether non-tax revenue, all appropriations from Parliament, and they should not just look at squeezing the existing players with license fees. But I think if the allocations come from Parliament, it should be justified by competence, forward thinking, and now that the capital markets are stretching into things like decentralized finance, those are areas they should also leverage. But my reading of everyone on that team, no one even knows what decentralized finance is. So the task ahead of them is daunting if they don't really become a little bit more aggressive in their forward-thinkingness.
Yeah. When recently you posted on your Twitter a comment on the minimum paid-up share capital schedules that were released, and the minimum venture capital fund, for example, is required to at least a minimum of 1.5 billion. and you called this madness. I'm just quoting your tweet. The Capital Markets Authority's madness keeps getting to your nerves, and by their very nature, the venture capital funds are risk-embracing. So, what is this? Does this mean?
You see, people at Capital Markets Authority have never structured a venture capital deal. I have done many of them. We have failed to get, during the last quarterly report that they released, they said that they had licensed one venture capital fund, but if you look keenly, it may even not be in your capital. It may not fall squarely into what they call a venture capital fund, but we have failed to domesticate venture capital. Most venture capital that comes into this economy is coming from other countries, from the global west, maybe Europe, even South Africa. We have failed to domesticate venture capital. And part of the reason is you have laws that are unfriendly. Now, when Capital Markets Authority comes in and sets minimum capital requirements, for a country that is struggling to domesticate non-bank capital, you have to ask, what is the risk? Because you see, and I've told people at Capital Markets Authority this very many times, if you're going to come up with the regulation, and these are not my words, Capital Markets Authority is signatory to the IOSCO. IOSCO is International Organization for Securities Commissions. It's like the UN of this industry. That UN of this industry has principles. There are 34, 32 in total. One of the principles states if you're going to come up with regulations that are touching on capital, financial, and prudential requirements in capital markets, they have to reflect the risk you're seeking to mitigate. Because unlike the banking industry, the capital markets rely on assets under management, and there's not much money you can create as a capital buffer to guarantee assets under management. You only look at the behavior. I would understand if Capital Markets Authority came up with venture capital regulations that are looking at conduct of how people are supposed to conduct themselves, rather than capital requirements. You're starting from the high end, you see? And world over, and I think I've also told it to them very many times, and I've also said it here.
What's the primary role of venture capital, so to say?
Venture capital looks at high risk, high growth businesses, like tech startups. Okay? So this is a risk embracing fund. Now, when you come up with regulations of 1.5 million, in paid up capital, because this is capital you're going to keep separate, you're not even going to employ it in your business operations. Yeah. It's paid up capital. Yeah. What risk are you seeking to mitigate? Because in the banking sector, why there is minimum capital requirements that are paid up is because they think that once the default, maybe the buffers for your capital will come in.
And that has also been raised from 25 billion to 150 billion by next year.
That was for the banking sector, but that's a story for another day that I have issues with it. Yes. But for the capital markets, you have to be very careful when you're setting minimum capital requirements. Because most money that is in the capital markets is employed in assets under management. It is not a liability on me, the person who's operating. So, okay, to just make the explanation even much simpler, there is no justification why a venture capital fund, which is not necessarily going to be a company, it can take the form of a partnership. It can take a form of a company with a variable capital like Mauritius. What Capital Markets Authority should be actually paying attention to are the investment vehicles these venture capital funds should take on, because that's the biggest problem. Because Mauritius are advanced, they have variable capital companies, sort of companies that have an umbrella, like you can have like 5 in one kind of companies, which are then there are limited partnerships. In Uganda under YOLO, you don't have limited partnerships, you have limited liability partnerships. Then you have to look at, those are the things you have to look at. But once you go on the high end of minimum capital requirements, then we ask you what is the risk. Because these are risk-embracing funds. They are very happy to talk on the risk because by their very nature, venture capital is funding high-risk businesses, most of which may not even have financial statements or financials. So when you come up with a regulation, what risk are you seeking to mitigate with that capital requirements? I've asked them that question and I failed to get an answer. So you come up with 1.5 billion as a minimum paid-up capital for a venture capital fund. What risk are you seeking to mitigate? If I get a satisfactory answer, I will keep quiet. But I have structured very many venture capital deals. And trust me, I don't think there's anyone in that room who has. And that is why they will come from a theoretical book theory angle and come up with the regulations that we saw. And by the way, that is just one part of the regulations. There are regulations that I think were beaten down earlier. They were seeking to classify a venture capital fund as a company, and they're trying to create all these sorts of governance, corporate governance procedures that are even impractical for a venture capital fund. So I think it is madness, really.
Looking at the last 10 years of Mr. Keith Kalijira, when you look at the portfolio here, it sounds like there's a lot that he has added to the capital markets of Uganda, including the success of the collective investment schemes, which have attracted 65,000 new investors and a 2.2 trillion Ugandan shillings market turnover. Amongst other things, he has also spearheaded the issuance of 110 billion Ugandan shillings in public and private debt. Do you think these could be some of the things that the new CEO should actually be starting from?
You see, I think the new CEO should look at breaking new horizons, because the capital markets in Uganda need disruption, by the way. And from where I stand, I don't see a very forward, and I think I've also made the point earlier. This lady that they brought in, I think Josephine, I think she's also doubling as a board member in the Bank of Uganda, if I'm not mistaken.
Yeah, she's actually also the new president of the ICBA Uganda.
When you get people from the banking sector to supervise what the capital markets, you have to be very careful. Because these are two competing industries in the financial sector. The capital markets employ a lot of assets under management, and they are in direct competition with the banking sector. Actually, the capital markets are supposed to be an alternative to the high interest rates we are getting in the banking sector. That's why you see things like in the private capital markets, you have venture capital, which they're trying to come up with funny regulations to stifle. So my lesson to, my 2 cents to the new lady that is coming in as the CEO of Capital Markets Authority is that she has to be very careful not to transplant the banking regulatory philosophy to the capital markets, because then there will be nothing new. It's going to be a continuance of more of the same. Because I've just explained. In the capital markets, these are securities that you're dealing with. People are floating securities and raising money. In the banking sector, people are getting money in form of loans, so we should see a capital market that is independent of the central bank. The more we see a capital markets authority that is under the wing of the central bank, it is not going to be vibrant, and you're going to see all sorts of crossovers from the central bank to, because many people in this economy think that because you know banking, you know the capital markets. That is not entirely true. That is not really true. Yes, she has a very good resume. I've read the resume. It's impressive, 27 years of experience. But if your mindset is not any different from the previous CEOs we have been having, then that means you're going to continue more of the same. I'm not trying to say she's going to do what her predecessors have been doing, but that is a cautionary statement that I think she should take from this conversation we're having today, that the capital market regulatory mindset is fundamentally different. The standards, the international standards for the capital markets are not the international standards for the banks. That's why even in the bill Honorable Nabeta is mooting, we are trying to remove the central bank or the person deputed by the central bank governor from the capital markets board, so that the board is independent and it can stand on its 2 feet and not knowing that's under the wing of another person from another regulatory body. So my 2 cents is anyone who's coming to the capital markets should make sure that the capital markets are an alternative to the high interest rates. That should be the first checklist. Anyone who fails to accomplish that, in my view, has not succeeded.
Absolutely. But Councillor, when I look at her profile, she broke her financial teeth at the Uganda National Social Security Fund in 1996 as an internal auditor, which is a plus for me. But then she also was a board member of Britam Holdings, and it's one of the well-known, at least one of the well-known fund management firms here in Uganda, and then later on joined Bank of Uganda as a board member in 2018. I think with this kind of experience, she has got a test. Yes, it might not have been for a prolonged period of time, but working with NSSF and then working with Britam Holdings, I think that would be a pretty good experience.
You see, I've just made the point. I'm not doubting her resume. Her resume, it's very impressive. You know, the reason that I am giving for people who are having a broad financial background, like in the banking sector, not just interfering in the capital markets, we've had a history. Let me give you a good example. One of the challenges that lies ahead of the new CEO of the Capital Markets Authority is the mess we're seeing in the bond market. People are actually putting in bids after successful auctions for their bonds, and they're not being credited, they're not being allotted on their accounts. Now, people think that the bond market is supposed to be regulated by BOU. That is wrong. The bond market, and the reason why we're having a lot of conflicts of interest, confusion in the bond market, is that you have people who think at the central bank, who think that securities regulation is their ambit. No. There is no, they fixed, the Bank of, when they passed the National Payment Systems Act, and I'm getting to the point of why her resume might be so impressive, but what we need is someone who has the right mentality. You may have all the good resume, but if you don't have the mentality, if you don't have the right mindset, the frame of mind for the industry. And the passion as well. Yes, by the way, the Capital Markets Authority needs someone who is very passionate. Yeah. And I was saying, you're taking it to the bond market. Now, she has to force herself to be in a battle with BOU to make sure the bond market is adequately regulated by the Capital Markets Authority.
I think that wouldn't that be an opportunity, having someone who is a board member and now is a CEO of the regulating body? I think she would be a voice, a good voice in the maybe on the board of Bank of Uganda to kind of let the capital markets loose from the Bank of Uganda stream. Don't you think?
No, it's going to create a lot of conflict of interest. When you have someone who is the CEO of Capital Markets Authority dabbling as somewhere in the central bank, and she's not the only person. You have a governor, Bank of Uganda, or he rarely sits there, but also someone deputed by him in writing to be on the board of CMA, is that the influence of BOU is overbearing. So you need a CMA which is fundamentally different. Now, the chaos in the bond market can only be remedied by making sure that the custody of government securities is regulated by the central bank. The bond market, which is supposed to be regulated by the capital market, so is very opaque. Okay? Recently, my friend Kakande put up a tweet, and I didn't even know what was going on until I saw the tweet. Okay, I had a background, but he actually made the point, because for him, he's not even in the country. He said people have been submitting, commercial banks are not submitting bids for the people who are opening up CSD accounts to trade. Now, why? There is a competition. You know, the banks also are in the bond market actively. Now, they will prioritize their bids ahead of you. And then, even then, if the custody of government securities is left with the central bank, which is also the issuer of the same securities, it's caused a conflict of interest, because it is like going to the market, at Seka Market here, you buy a cloth and then you leave it with a vendor and you say you bought the cloth. World over, the safekeeping, what you call custody of government bonds, is actually done by independent companies that are licensed by our equivalent of Capital Markets Authority. But you have that confusion in our law. And trust me, in the near future, if this chaos continues, very many people are going to lose confidence in lending government money. So it is in the best interest of whoever is coming in as a new CEO to make sure that that battle, and it has to be a battle, because the central bank is just not going to let go. But in my view, you can't be an issue like, now look at how we look at the equities markets. Once you buy shares for MTN, and USE is trading them. USE has created another different company that does the settlement and custody. Yeah. It should be the same thing, because even world over, if you look at the UK gilts, the UK bonds, they call them gilts, the UK bonds. The custody and safekeeping of those bonds is with a separate company called Euroclear, the Crest system. It's in the Crest group of companies, Euroclear. It is not with the Central Bank of the UK. Yeah. So there is a lot of confusion in the bond market, which ideally should be our flagship market in the securities sector. So if you're having people at BOU, and by the way, we've had these are the issues Ordinary Bonavita is putting in the bill, in the proposed private members bill, that the bond market should not be supervised. And even the Auditor General, shockingly, last year in the financial statement, in the audit report for 2022, if you look at the segment for capital markets, He queried and was like, why aren't the players, the banks that are doing the dealer banks in the bond market, why are they not licensed? We wrote back to the auditor general and told him no. Actually, the problem is much deeper than that. Even though CMA licenses the dealer banks, it will not be in position to see what is going on there. There are very many people who have failed, whose bids have not submitted deliberately. Because of conflict of interest with the banks, they want to take the lion's share. So there is a lot of confusion in the bond market, which is supposed to be supervised by CMA, but it is not for, because of BOU's overbearing influence. So I would say that her CV is impressive. It is very nice. I know one disputes it, but your capacity to do the job does not lie in the books and your experience you had very many years ago. Yes, it contributes 50%, but then the other side of the balance sheet deals with passion, deals with having the right mindset. If you don't have people who have those aspects that are on the other side of the balance sheet, then you lose on the equation.
One of the challenges, Council, of our capital markets here in Uganda and in East Africa generally is, first of all, very little retail investors. We have few retail investors, big institutional investors like NSSF dominating the market. In Nairobi, they have had 7 years now with no new listing. That's a very, very great drought of IPOs. And they have now, reviewed some of their regulations. Yes, and now instead of, in the last 5 years, they only require 1 year of profitability for you to be able to actually list in your prospectus. I don't know what the rules are for Uganda. 3 years still, which has been in Nairobi. Don't you think it's also high time we also revise some of these rules and bureaucratic policies that are actually stifling the growth of the markets, especially on the retail basis?
That is very true. What Nairobi is doing is right. But you see, when I was here last time, I told you that the Nairobi Securities Exchange and the Kenyan capital markets should not be our best benchmark. Why? They have existed for 70 years, and in the 70 years of existence, they've only listed around 63, 64 securities. So that is not a place you can say it's the gold standard. And these are things we have told people. You see, part of the reason why we told Honorable to come up with a bill is that we had a hard time convincing people at the Capital Markets Authority of the nature of regulation that they need to do. So if Nairobi is trying to, Nairobi Securities Exchange and the Capital Markets Authority of Kenya is trying to loosen the listing rules, that for them might be just one part of the problem. The other part of the problem is making sure the capital markets are vibrant. And the capital markets being vibrant means you have to have a deliberate government strategy. It's very aggressive. See? Part of the reason...
Countries like Mauritius...
And Mauritius is doing very well. Yeah, Mauritius is the financial hub of Africa. Why is Mauritius the financial hub of Africa? It's because there is a deliberate government position to make sure that they are the financial hub of this continent. The reason why the South African market is dying, yes, it's still very big. It's big. They have around 4,000, 3,000 listed companies. That's a very big number. But the reason why it's dying is because the government has taken a nap. Nairobi market used to be aggressive until they came up with this kind of regulatory overreach that we are seeing bordering in Uganda right now, where CMA just copies what is in Kenya. And we have told them just don't copy. And because Kenya, they had a lot of fraudsters in the early 2000s. So they had to come up with some kind of stringent regulations to put out fake brokerages. Let me give you brokerages. Now, the thing is, the Nairobi Securities Exchange, the Kenyan capital markets are doing their best, but there's a problem with the African capital markets. Personally, from a personal point of view, I don't see a reason why you have Uganda. These are small economies. Why would you have a Uganda Stock Exchange, then the Nairobi somewhere, then the Dar es Salaam somewhere? I would think that, okay, they should maintain the status of having those exchanges, but we should have an exchange where if you're from Kenya, you can list. If you're from Uganda, you can list. We should have that kind of integration. I'm told they're working on it, but it may not be what I envisage it. I want it to be. I'm told that the regulators in Kenya and Uganda, when they had their meeting recently, they're trying to integrate, but it might not be what ideally would suit the market. But what I would think is the future is in integration. Because if someone is going to invest in securities from the US and their equities, he might want to know what is the retail investor base. If it's very small, that means the liquidity is also very low. And and like you've seen our markets here are very liquid, even when they don't need to be. So I would think that the Nairobi Stock Exchange and the Capital Markets Authority of Kenya are doing something great, but just loosening listing rules might not be enough. They might need to look at more disruptive, we should leverage technology. There should be deliberate government aim. Say, now, how can we even subsidize the industry? But my prediction is, in the next 10 years, the capital markets in this continent, especially Kenya and Uganda, are going to shrink further. Much further. Why? Because of, one, regulatory issues, that is one of them, and then the economies are also shrinking. So if you fuse that, and then the governments are not as invested to grow them. So I think the markets, and I'm very sorry to be this pessimistic, they're actually going to shrink.
Well, we're going to pick it up from right there after this break. That was, of course, part one of our series here on the new appointments at the Capital Markets Authority. In our next part, we'll be still tackling some of the hindrances to retail investment when it comes to capital markets, with the dominance of very many institutional investors, very few retail investors. What is the impact of this, and how can we get out of this stress? And then we have, of course, a couple of companies that have had takeovers and mergers, and now, unlike the usual business in the financial services sector and the real estate sector, in the manufacturing sector, including Hima Cement and Cipla Quality Chemicals, is this a good move for companies here in Uganda? My name is Anthony. We'll be right back.